Next week, the Federal Reserve will hold its final meeting of the year. The good news is that it won't raise interest rates. The bad news, it still believes prosperity causes inflation, which means unnecessary trouble for 2024. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. Stocks last month enjoyed a rip-roaring rally. Markets anticipate that the Federal Reserve will start cutting interest rates next year. When it gets together, the Fed is expected not only to refrain from raising rates, but also to hint of reductions to come. Not so fast. Our central bank is still in the grips of a pernicious economic theory called the Phillips Curve, which posits that there's an inverse and stable relationship between inflation and unemployment. That is, if you want low inflation, you must have a weaker economy with higher unemployment. Conversely, a strong economy and low unemployment beget higher inflation. Experience shows the theory to be false. Right now, unemployment remains low and inflation rates have come down. But it's a peculiarity of human nature that people can still cling to false ideas or fake facts even when reality proves them wrong. The sad truth of that phenomenon was demonstrated recently in speeches delivered by two key Federal Reserve governors, Chris Waller and Michelle Bowman. A news headline told you all you needed to know. Quote, Fed's Waller says economy may be slowing enough to tame inflation. Fed's Bowman not convinced, unquote. In his remarks, Waller did caution that, quote, while I'm encouraged by the early signs of moderating economic activity in the fourth quarter based on the data in hand, inflation is still too high, and it's too early to say whether the slowing that we are seeing will be sustained, end quote. Ponder those words. He's hoping the economy will get worse. So does Governor Bowman. She thinks rates must be boosted further to really weaken the economy and get inflation down to the Fed's 2% target. As Fed head Jerome Powell stated in 2022, our central bank must not take its boots off the economy's neck until the inflation virus has truly been contained. He and other Fedsters think the central bank always eased too quickly during the terrible inflation of the 1970s. Only until then Fed head Paul Volcker engineered a bone-crunching recession was the disease cured. Powell is wrong. It was what the Fed did afterwards that did the deed of conquering inflation. It stopped undermining the value of the dollar. What central bankers and most economists don't get is that the definition of inflation is lowering the value of a currency, usually by creating too much of it. Economic growth doesn't cause inflation. Printing too much money does. If the Fed next week declared that henceforth its objective will be a sound and stable dollar and that it will cease trying to trash the economy, markets would really boom and the economy would get healthier. But sadly, bad ideas are hard to kill. We'll need a new president who actually understands money to do that. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions. I look forward to being with you soon again.